week.
Recording in
You'll
progress.
find there's a lot of similarities with this week and last week with only slight differences, but it's enough differences for it to be a whole different topic itself. So this week in particular, we look at negligence again. So within the realm of tort law, but we look at pure economic loss. So a little bit of housekeeping as always, every single Tuesday and Thursday. So there's only going to be 2 more sessions after this one as well, before you guys have SWOT back and your final exam. And then the attendance link that I'll pop it in chat as well for those that just joined a little bit late. Guys could on out to receive the PowerPoint presentation after. So beautiful. Now again, like I told you guys, this is the final week that we will be looking at the law of torts. It does make up majority of your marks in your exam, so it is the most important topic as well. And again, our focus today is just pure economic loss. So last week we looked at 3 possible scenarios that could happen in tort. So the first one being physical harm, second one mental injury, and third one liability for omissions. But this week when we talk about pure economic loss, there's 2 types of scenarios you guys will only ever get asked on. The first one is actions that cause pure economic loss. So if you do something to someone and they suffered, financial loss, that would fall under category number 4. And number 5, negligent statements causing pure economic loss. So what is it? I'll tell you guys what number 5 is by giving you guys a little bit of an example. So consider this scenario here. You hire an accountant, because when you're a little bit older and you have investment properties, that type of stuff, the way you do your taxes is a little bit different. So a lot of people when they're older, they hire accountants to do it for them to simplify it. It's tax deductible as well. So there's a lot of incentives to use an accountant. So say you get an accountant to do your taxes, but they do it wrong. They over exaggerate your deductions and under-report your income and inflate your expenses. So what do you guys think would happen? Well, what would happen to your tax return? So I'm sure that some of you guys would have gotten taxed and would have needed to do your taxes already. Does anyone have any ideas what would happen to your tax return? Well, would it be higher or lower if they over exaggerate your deductions and under-report your income? Would you get more back or less back? No. So everyone said less so far, but that's actually not correct. So you actually get more back. So for example, if you get $100,000, right? And then they deduct you $60,000. So that means your taxable income would have only been $40,000. But if they over exaggerate it, that means you would get more back. If they underreport your income, then they say you earn less than what you actually should. So therefore, you should get taxed less. So in reality, you would actually get more back from the ATO. So an example of this essentially is illegal. When you underreport your income and inflate your expenses and say that you have higher deductions than what you normally should, you will actually get more back from the ATO. And that's also illegal. So what would happen now is the ATO will hunt down people that do this. And essentially, it begs the question then, who becomes liable? Does your accountant become liable, or do you become liable because it's your own taxes? So this is something that we would call a second party. Your advice giver in this scenario is your accountant, and they give advice to you. You are someone that wants their taxes to be done. So we'll look at the tests that would determine who becomes liable a little bit later on, but that's what I mean when I say statements causing pure economic loss. They've said something or they've done something for you that's given pure economic loss. And now to continue on from this as well, when you buy a house, you probably cannot do it by yourself. You probably have to talk to a mortgage broker, and they'll tell you that you need a certain amount of assets, documents, income statements, asset statements, that type of stuff. So again, you turn to your accountant to request for this information as well. And like before, they over exaggerate your income and inflate your asset expenses. So they say you have $300,000 worth of assets when in reality you only have $200,000. So what would happen in this instance? You'll talk to an accountant. So here, instead of talking to a mortgage broker, you'll talk to an accountant. They'll provide you the documents, so your income statement, your assets, and after that, you'll of course have to turn to a bank to get a loan because not a lot of people can afford to buy a house outright. So you have to talk to a bank to determine how long your loan is, how much it's going to be, what your repayments are, that type of stuff. So that's the process that would generally happen. You'll speak to an accountant, they'll prepare documents for you, then you give it to the bank, and then they approve your loan based on the information you provided. So this is an example of what we would call third party. So I'd give there and then advice seeker here, that would be you. So your accountant provides you your asset documents, and then you give your asset documents to the bank for them to prove or reject your loan, that type of idea. So again, think about what would happen in this case. If they say you earn more than what you would actually earn, then it's more likely the bank would approve that loan then because they would say that you can afford it. So then then it begs the question again, what happens if the bank finds out that your assets isn't actually what it is? Who becomes liable? Do you become liable to the bank or does the accountant become liable to the bank? So that's what we have to determine in this scenario here. And these are the only two possible scenarios you guys will ever get asked on. So I've highlighted it in green. So pure economic loss due to actions, that's
Hello,
the green
kung
one, and pure economic loss due to statements,
Yeah.
you'll either get a question on second party or a question on third party. So again, it's really important that you guys are able to determine which one is which,
Cái
whether or not
ăn
it's
màu
second
gì
party
cô?
or third party, because then you'll have to apply different types of tests in order to determine which one. So for a third party, the question then becomes, does the bank or does the accountant owe a duty of care to the bank? That's what third party is. And second party is, does the accountant owe a duty of care to me, someone that actually sought advice from the accountant? So that's what third party is over there. And you always have to determine which one is which. So again, the 4 steps that we have to establish whether or not negligence has occurred is the exact same 4 steps. First one, is there a duty of care? Second, is there a breach? Third one, what damages the damages test, and the fourth one is defenses as always. So the only thing that's different is establishing whether or not there is a duty of care. So pure economic loss due to actions, you guys will apply the pair be upon test, the famous test regarding the potatoes. So that one's pretty self-explanatory there. One thing I'll quickly highlight as well, if indeterminacy is an issue in any of these scenarios, then there is an unlikely chance to be a duty of care. Not even unlikely, then there will not be a duty of care if indeterminacy is an issue. So what is indeterminacy? So for example, in the pair v upon test that in pair v upon, you guys would have learned that upon brought in, potatoes that were, genetically modified because they were, like antibacterial, they grew really well, they were really good at growing, that type of stuff. So upon really wanted these potatoes because he could propagate them a lot easier. But what actually ended up happening was that the potatoes actually caused a bacterial infection and it spread to the surrounding lands within a 20-kilometer radius. And so anywhere within that 20-kilometer radius, crops were no longer able to be grown because of this bacterial infection. So what indeterminacy is, what that means in this scenario is indeterminacy is when it only affects a finite number of people. So for example, if what happened in a pond, instead of it affecting only 20 kilometers, it affected the whole of Australia, then we would say it is indeterminate because we can't determine how many people actually become affected in this case because it's too broad. But if it's only within a 20-kilometer radius, we'll be able to count it. We'll be able to determine how many actual physical people